Welcome back in YouTube. So in this video, we're going to dive into a stock that is down over 65%, has been paying dividends for over 50 years. And with the home builders exploding, this stock has been lagging, which I find pretty interesting and could be a massive opportunity. We're talking about Stanley Black & Decker. By the way, if you're new to the channel, welcome in, consider subscribing, and you know what to do with that thumbs up here. Just hit the thumbs up. Get that YouTube algorithm going. All right, so first and foremost, let's talk about KB Homes, which is in the red, versus Stanley Black & Decker. Now, normally you get a pretty solid correlation with the home builders and something like Stanley Black & Decker, as this is the name for household hardware. We're talking about DeWalt, obviously Stanley Black & Decker, Craftsman, Bostitch, and more. Anybody that is a homeowner or that does any sort of repairs, I'm sure is familiar with all these brands. And with the housing shortages taking place and the fact that the home builders are absolutely skyrocketing, we're seeing a massive divergence recently versus a Stanley Black & Decker. Now just take a look at this correlation over the last 5 years, basically trading in somewhat of unison. Yes, you do have some Yes, you do have some recent outperformance with the home builder versus Stanley Black & Decker, but generally moving in the same direction. Until the 1-year chart comes up, we get an absolute divergence here. Home builders like KB Homes are up 90% on the year, while Stanley Black & Decker is down 12.5%. And the contrarian trade would be that Stanley Black & Decker here would be able to catch up to the home builders. But when we talk about the history of this company, basically the backdrop of what's taking place with the housing shortages and more homes needing to be built, I see a massive tailwind for this company here. So we're going to dive into the stock. So let's point out the obvious, as we always do on the channel here. We want top line revenue growth, and we do get top line revenue growth with a company like Stanley Black & Decker here, going from 11.3 billion, nearly $17 billion in the trailing 12-month. But take a look at the operating income here. While we're getting that massive top line revenue growth, and we normally see operating income fall in line pretty strong, take a look at this: nearly $17 billion of top line revenue. But when we bring it down to operating income, it comes down to $604 million, which is a big red flag. And obviously the stock is getting hammered for this. The company lost roughly $2 billion, and when we bring it down to a per share basis, that's $13.45 per share, which is going to do a few different things here. Definitely could put the dividend in jeopardy. And so I want you guys to remember, I did call AT&T getting rid of a dividend. We're going to take a look at where we are with Stanley Black & Decker. If they don't turn this around soon, I could see a dividend slash here, which would definitely hurt the stock, considering how many people are probably reliant on that income, how many people rely on the dividend, and that the fact that it's been a dividend staple for 54 years definitely could send some shockwaves through the stock if they cut or canceled the dividend for an extended period of time. This is definitely an inefficiency we are seeing in the business, and this is something where you're really going to have to listen to the phone calls and try to make sense if this is fixable, because we're seeing the top line revenue growth, but that top line revenue growth is basically negligible considering how much more they're spending on cost of sales, which is taking away all the gains that they would be having from top line revenue. And we're also seeing a jump in long-term debt here, going from 4.3 billion up to 5.3 billion. So they added roughly $1 billion of long-term liabilities on the balance sheet. I think they could do between 500 million to $1 billion of free cash flow if they got things back to normal. And when you look at the debt load that they're starting to take on here, I would definitely say this is a little bit of red flags. We can see the net debt trending in the wrong direction here, getting over $7 billion. And this is a company that, does between, as I stated before, about 500 million to $1 billion of free cash flow. And, you're talking about 7 to 10 year pay down period here, which is starting to get into mucky waters, in my opinion. Not the cleanest of balance sheets. And then, they have the obligation at this point in time to pay out that dividend, which now becomes a little bit of a headache here. We have analysts forecasting between $80 to $125 a share. Yahoo Finance is actually projecting out roughly 20% annualized growth rates here, which is pretty friggin' high. And when we go to stock analysis, we're getting a whole nother story here where they're expecting a negative year in 2023 and slow growth going forward. And somewhere in the middle, I think, is the truth. I think 4 to 5% revenue growth could make sense. So we're going to go 4% revenue growth from years 1 through 3, saying that the consumer could be in a tough spot, but the housing shortage is still going to put a bid under their growth. Years 3 through 6, we see a little bit stronger consumer. In years 6 through 10, we come back down to more of a 2 to 3% rate here. Margins are definitely a problem right now, so we're going to do 10% margins for the next couple of years, 11% from years 3 through 6. Now, historically, we can see here they've done between 10 to 16% margins, so we're just going to go under this just to build some safety for us. When we think about multiple on the stock here, we can see that EV to EBITDA is trading right around 17, which is pretty significant premium to their peers. And so with Stanley Black & Decker using very, very low, very average growth rates and them getting back to a normal margin type of business here, stating that, inflation is definitely a big problem right now. The cash position is a little bit of a problem, and the fact that they're taking on a little bit more debt now. Balance sheet is not as clean as it used to be. But when we look at the grand scheme of things here, if you think this is something that they can get out of, and I tend to think they will get out of this just fine, and I think the macro backdrop really supports their business long term here, that there's going to be a heck of a tailwind. I tend to think I'm undershooting the stock, but at this point in time, I think $75 gets really interesting on this stock. Personally, yeah, that $75 price target seems to be pretty interesting to me overall. Definitely would probably nibble at Stanley Black & Decker at those levels, and if it got beneath that, be pretty interesting depending on the balance sheet. Let me know what your thoughts are on Stanley Black & Decker. Hopefully everybody enjoyed that, and we will see you in the next one. Peace.